Happy Friday, everyone. Welcome to this edition of Business Daily. I'm Hwang Jie in Seoul, and let's get started with a look at the day's highlights. Korea's output across all industries rose for the second straight month in June on the back of solid consumption, but there are concerns about the pace of growth, suffering a setback in the second half of the year. The Bank of Japan falls short of market expectations as it keeps its policy rate steady and refrains from bolstering government bond purchases. These stories and more coming right up. As Korea's traditional growth engine exports suffer from sluggish global demand, the country's services managed to pull ahead growth. But maintaining this momentum in second half may be an upward battle as a tax cut program has come to an end and corporate restructuring is still in motion. Kim Min-ji with the latest.
Korea's output across all industries has risen for a second straight month. Statistics Korea says overall production inched up 0.6% in June from the previous month. The June figure was led by robust activity in the services sector, which rose 1% on month, mainly due to an uptick in sports and leisure activities, thanks to warmer temperatures and a lift in the financial sector attributed to the record low interest rate. But the country's industrial output fell 0.2% on month.
Production in the mining and manufacturing sector fell due to slowing exports, as well as the base effect from last month, when it rose 2.7%.
Korea's exports, once the main pillar of the economy, have been on a downward spiral for a year and a half now, although the pace of decline did slow in June. While the overall output figures mark a significant recovery from the previous year, experts caution against too much optimism.
Because the cut in consumption tax on automobiles ended last month, it'll probably pull down domestic demand. Also, plant utilization in the manufacturing sector hovers in the early 70% range, and sluggish exports aren't helping much either.
On top of that, the full-blown impact of the government's ongoing push for corporate restructuring, which may start to materialize, as well as strikes in the automobile industry that are expected to trigger a decline in production and sales, remain risks to Korea's industrial activity in the second half. Experts say while the government's recent stimulus measures may be able to breathe some life into the local economy, the overall conditions can only improve if the global economy also picks up steam. Kim Min-ji, Business Daily.
Yet another concern about further weakening in domestic consumption has emerged just after Korea's Constitutional Court ruled in support of the controversial anti-graft law on Thursday. Korea Economic Research Institute says the law dubbed the Kim Young-nan Act will weaken the already sluggish economy by discouraging domestic spending even more, resulting in a loss of roughly $10 billion annually. The decision subjects millions of public servants, journalists, and private school teachers, as well as their spouses, to criminal charges if they're found to be treated expensive meals and gifts exceeding certain limits. But other experts say while the regulation may discourage economic growth temporarily, it will eventually reduce corruption and increase transparency, benefiting the economy in the long run. Despite lingering uncertainties abroad, Korea's leading corporations have managed to remain profitable in the first half of this year. After analyzing the performances of some 20 companies in major industries like electronics and automobiles, industry tracker FN Guide said Friday that the combined operating profit of the firms came in at around $30 billion in the January to June period. That's up 6.1% from the same period last year. Industry watchers say the rise came on the back of cost-reducing efforts, but add Brexit uncertainties and the sluggish pace of recovery in the domestic economy will continue to threaten their performance. The data was based on leading companies with sales of more than roughly $4.5 billion in the first half that have released their second quarter earnings. Korea's Creative Economy Innovation Centers, launched to support local startups, are celebrating a year of fostering creative ideas and boosting economic growth. Our Kim Hae-sung shares some of their successes as they mark their first anniversary.
6 startups shared their successes at an event for the centers that helped them get off the ground. Korea's creative economy and innovation centers were launched by the government 1 year ago to foster the burgeoning startup environment in Korea. The Minister of Science, ICT, and Future Planning outlined their successes at a press conference in Seoul on Thursday.
Our centers have provided networks and know-how to startups and SMEs in Korea and expanded our creative economy platforms. We plan to continue our efforts and aim to become one of the top 7 startup nations in the world by 2017.
As of July this year, the 17 centers around the country have supported over 2,800 Korean startups and SMEs, helping them raise $250 million in funding and created up to 1,400 new jobs. Since opening a year ago, creative economy innovation centers like this one in Seoul have offered one-on-one consulting services and customized support like funding and networking to help startups turn their ideas into products. Many of the startups have seen their collaborations with the centers come to fruition, including the smartwatch company. It makes smartwatches that can turn text messages into Braille for visually impaired users in real time.
We started in 2014 of June, and we were only college students who had only ideas. So from this center, we got a lot of support, including mentoring. Recently, we could sell our product in 40 different countries, and we have raised $5 million.
In addition to funding, some small and medium-sized enterprises like this one have been able to launch their products through networking.
Through the center, we were able to network and show our ideas to large conglomerates, and we're going to launch our slim-size speaker later this year.
To further boost the momentum, the Future Ministry plans to inject more resources into the innovation centers, which means Korea is likely to see the launch of even more startups in the coming years. Kim Hae-sung, Business Daily.
Home prices here in Seoul have reached a record high in the first half of this year, making it more difficult for people to live in their own homes in the capital city. So what's driving up the home prices? Our Lee Ju-young explains.
It's becoming increasingly harder to live in Seoul as average home prices in the capital have exceeded the 550 million won mark, or $480,000 for the first time in the first half of this year. Korea Appraisal Board says prices surged particularly in the Gangnam-gu district, south of the Hangang River, due to a redevelopment boom. With that, apartment prices in the country's capital grew about 3 times faster than the nationwide growth rate, slightly under 0.4%.
Home prices in the Seoul metropolitan area rose due to a redevelopment boom, but elsewhere they've slowed due to tighter debt control.
The appraisal board says apartment prices in Seoul will continue to edge up by 0.3% in the second half of this year due to factors not limited to the domestic economy.
There's increased uncertainty due to Brexit in the local economy. Despite these negative factors, there will still be demand for homes due to low interest rates.
The institute also adds that the rising lump sum chunse deposits will nudge renters to buy their own homes, which would further drive up prices. Chunse levels in some parts of Seoul have reached as high as 80% of the home value. Lee Ju-young, Business Daily.
On the global front, all eyes were on the Bank of Japan today as expectations were high. The central bank would present a boosted stimulus package to help the world's third largest economy get back on track. Our Eunice Kim is in the studio to talk about this further. Thanks for joining us today, Eunice.
Thank you for having me.
So there was a lot of pressure on the BOJ to act this month, but it wasn't good enough for investors, I guess.
Yeah, early indications are definitely pointing to that, isn't it? And, you know, there was a bit of a boost from the BOJ today, but we'll get into that in a little bit. Let's first start with the U.S. central bank's inaction on Thursday. Take a look. In July's policy meeting, the U.S. central bank kept its benchmark interest rate below 0.5%, leaving the door open to a potential rate hike later this year, noting what it viewed as shrinking near-term risks. And the opinion that the domestic economy was moving at a moderate pace was affirmed by eye-catching earnings reports this week, particularly from the tech sector. Facebook crushed its earnings expectations, raising its profit by 185% on year. It brought in $6.4 billion in revenue, beating market projections by $600 million. Google's parent company, Alphabet, reported a quarterly revenue jump of more than 20% on the back of strong mobile advertising sales. Amazon showed off an amazing turnaround, reporting a back-to-back record-breaking net income figure of $857 million, a profits growth of more than 800% year-over-year, thanks in part to its foray into cloud services. But on this Friday, market attention shifts to Japan. In the lead-up to Bank of Japan's July monetary meeting, markets had priced in a plumped-up stimulus to come from Governor Haruhiko Kuroda, no less buoyed by Prime Minister Shinzo Abe's surprise announcement earlier in the week of a 28 trillion yen spending package to inject life into the Japanese economy.
This new plan will need to support domestic demand and ensure that the economy returns growth. I would like to compile fiscal measures of about 13 trillion yen and a stimulus package of about 13 trillion yen in size by next week.
Next week is also when we'll likely know how much new spending is actually in that $265 billion fiscal package. And as the Tokyo government, with stagnant tax revenues, has little funds to draw from, the hastily prepared briefing was seen as pressure on the BOJ to come up with a way to equip the central government with more money by way of bond purchases. Add to that a data dump from Japan's June readings out early Friday that was rather lackluster. Core consumer prices minus fresh food, an important gauge of inflation, came in worse than economists' estimates, shedding 50 basis points. A key driver of growth, household spending was also down 2.2%. Japan's retail trade also came in worse than analysts' expectations, 20 basis points lower at minus 1.4%.
So Eunice, I guess those figures make the next meeting very important in that they keep speculations of further easing alive, and especially in that the monetary decision that came just hours ago wasn't really living up to investors' expectations.
You're absolutely right, Chihei. There was no additional quantitative easing, no additional bond buying, more or less, which is what investors were, of course, looking for. But one notable change, let's go ahead and take a look, shall we? Contrary to expectations, there was no further cut on the minus 0.1% interest rate on excess reserves. ETF purchases were raised to 6 trillion yen annually from what was 3.3 trillion yen. ETFs, of course, being short for exchange-traded funds. But JGB's, Japanese government bond purchases, remained at 80 trillion yen, despite that push that we saw from Prime Minister Shinzo Abe on Wednesday this week.
So how did the markets react to the latest decision from the BOJ?
Well, we certainly saw the yen, Japanese currency, swinging throughout the day ahead of that lunchtime announcement from the Bank of Japan. Here's how it went down today, starting off with the trading day at about 104.8 yen to the dollar. The Japanese currency was seen strengthening against the greenback around lunchtime. It continued its swing in the afternoon trading hours and was at 103.4 yen to the greenback less than an hour ago. Many investors and Japan watchers now scratching their heads, wondering how this package is going to get the economy back to the BOJ's 2% inflation target, from which it is very far behind.
So over in the U.S., Eunice, the Democratic and Republican parties have both nominated their presidential candidates for the election in November. And the longtime politician Hillary Clinton made history there. Could you tell us more about that?
Absolutely. Historic times indeed, isn't it? Just a few hours ago, Hillary Clinton accepted the Democratic Party's nomination for president at its national convention in Philadelphia. There she said this was a moment of reckoning, as she underlined that it won't just take one person, but a whole village to push America into a brighter future.
America needs every one of us to lend our energy, our talents, our ambition to making our nation better and stronger. I believe that with all my heart. That's the future we're working toward. And so, my friends, it is with humility, determination, and boundless confidence in America's promise that I accept your nomination for President of the United States.
Stronger Together has been Hillary's slogan, and in her historic address, she set herself apart from her opponent, GOP's Donald Trump, by pointing to her proven record of working with both sides of the political aisle to get things done in Washington. She also showed a softer side by recalling her mother's story, how she was abandoned at the age of 14, and that the lesson she learned from her mother was that no one gets through life alone. Hillary's speech almost entirely discussed domestic issues, though she did indicate her government would say no to, quote, unfair trade deals and stand up to China, and also, of course, bring back jobs to the U.S.
All right, thank you so much for coming in today, Eunice.
Thank you for having me.
And that brings us to the end of our show. Thank you so much for watching. We will be back next week at the same time. Goodbye for now.